Good day, fellow investors. Food stocks like flour foods are getting cheaper. On one hand, we have to eat, so let's look if there is an interesting investing opportunity there. If we look at what's going on with flour foods, this is absolute destruction, 60% down. The P ratio now is 11. The dividend yield is a staggering 9.52%. Let's look a little bit on the business. So packaged, prepackaged bread, which is something my wife would be completely against. So if you have a health nut like I do in your house and she complains about you watching my videos, send her to my wife's channel. Going back to flour foods, bakeries, distributions across the United States, as you can see here, more in the south part. They have done a lot of acquisitions to grow over time. And we have market share, good market shares, branded. They are also a little bit going away from private, that's getting hammered now by channel, supermarket, drugstore, mass discount, and all other. They have made some acquisitions, they have stable sales. So this, when you see 1.2% growth in net sales with 3 to 4% inflation, that means that they are already looking into a decline in sales. However, if they focus on profitability, things should be good. Another recent acquisitions that creates an interesting situation for flour foods, perhaps giving it a cheaper investing opportunity if they need to cut the dividend to improve the debt situation over time. Also, perhaps, given the company I don't think makes much profits, risky bet, but if they can improve the margins, then it should, let's say, lead to some growth over time. There are cash flows, cash flow from operations, minus capex, dividends, doesn't leave a lot of room to lower the debt that is already there in acquisition. So many think that the dividend will be cut. That's likely already priced in given the 9-10% yield. However, also there were some slowdowns, net income down, EBITDA down a little bit, but the guidance is still there. Cash flows, capex, things like that, stable, profitable, no growth, no stellar, but this was a growth story. Then when it changes, this is what usually happens to growth stories. However, we must now focus on what is now and look where it will go next. They have been stable, especially, look, recessions, okay, people were more at home, this was stable, so perhaps even in a recession people eat more bread and less eating out. Company has had stable cash flows. Is this enough for the dividend? That's what I'm already watching. If they cut the dividend, that would make it perhaps even more interesting because cash flows are there and are value creation. Also another acquisition in the past, so they are very aggressive there, paying dividends and also doing some buybacks. That's the track record of delevering after acquisitions. I have seen more companies doing that, even very successfully. So you can see here the growth, EBITDA, okay, net debt stabilizing, but of course you need to bring it lower to keep things sustainable. They have issued long-term debt, short-term debt. This is something they will have to refinance. Maybe they cut the dividend to refinance this, then they are again free for a while. So up till now, growth, M&A, good position, stable cash flows. Yes, bread consumption is declining. I should eat a little bit less. Okay, but everything looks okay up till now. And then my next part is, okay, let's read about this company wherever I can find ideas. I go to Seeking Alpha to read what others are saying, to find information, and we have one strong buy, sell and sell. Dividend is cut, dividend is cut, so that's why you should sell a stock even if it's already down. So that's usually how analysts look at things. And if the dividend is cut, that's something I read from Peter Lynch, a dividend cut is never already priced in. So if there is a dividend cut, it might even push the stock lower a little bit more. However, the question is, okay, consumer sentiment, what's driving this? Well, I don't know whether consumer sentiment can be related to bread. So yes, American consumers are weaker. Everywhere I look at these conference calls, weaker, 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 but nobody cares. They are going to eat AI chips, right? Anyway, when they make the acquisition, if they can improve margins, integrate, that should be a good positive. A little bit improving the cash flows, perhaps allowing for debt lowering. So a very interesting situation. However, the key question is first on the dividend and the cash balance between reducing capex, paying dividend, and whether the dividend is an appropriate level. The question was not direct. The board will decide what to do with the dividend, so the CFO didn't answer on that. Whether they cut the dividend or not, even if you're lowering that with your cash flows, that's still value creation from an investing perspective. Sooner or later you'll benefit from that. So my opinion is still that this is very interesting, and now one should go and research past similar situations, which I don't have the experience to do. However, my assistant does. This is AI search powered at a 10x. So I can ask to give me historical comparisons to other things, what's going on. This is Hostess brands, now owned by JM Smucker. Margin pressures, things like that. Okay, and then they adjust things and should be okay. Grupo Bimbo from Mexico. So again, bread buns, there were these issues that can be adjusted over time thanks to the market position. So if we look at this company now at this price, value from a private owner, good cash flows, 10 to 12 times EBITDA should be achievable, especially in this private equity craziness that we are living in. If we look at the situation, EBITDA 500 million times 10 is 5 billion. 5 billion EBITDA minus long-term debt 1.7, let's put 2, that's 3 billion. So from a market cap perspective, value to private owner, there is 30% upside. I don't know whether the management or the owner's intention is to sell now. I think they will try to revert this, but there is a margin of safety, something that makes it interesting in private ownership. Therefore, I said, okay, we have a 10% cash flow yield, a 10% dividend yield, depending on how it's going to be distributed. We have a very positive situation, margin of safety, private owner, potential risk from a dividend cut and declining demand for bread. But I have added it to the quadrant, so we're going to watch it over time, see whether it gets even cheaper on a dividend cut, and that makes it extremely interesting. Whether it is a buy now already, if you can stage the purchases, you say, okay, I'm buying now, first stage, if it goes 20-30% lower, you buy another one, and then, God forbid, you have another stage buy, that would be interesting. I personally don't know much about the sector, even if it's bread and I like bread. However, I want to step by step, dig a little bit deeper, take bite by bite, crumb by crumb, and let's see over the next 6 months whether it is even more attractive for me personally. That's always, okay, do I have better personally? Yes, on my research platform I have better for now, so I'm not rushing in. Perhaps it could be something for my diversified portfolio, but I also want to learn more and understand more. You can check what I do on my research platform, subscribe for more, and we'll keep on following.